Hi everybody, welcome back. In this video lecture, we're going to write the journal entries necessary to record the transactions for Warner Company for year 1 and year 2. We've already done all the work necessary in prior video lectures, so we're ready now to write our journal entries. The first transaction is on April 22nd. We purchased $5,000 of merchandise on credit from Fox Pro, terms net 30. You go ahead and write that journal entry. Then start the video again and check your work. This was a pretty straightforward journal entry. We debited merchandise inventory and credited accounts payable Fox Pro for $5,000. On May 23rd, we replaced this accounts payable with a note payable. We paid Fox Pro $400, reducing the $5,000 balance down to $4,600, and instead of paying that amount, we signed a note payable, giving us an extra 60 days to come up with the $4,600. Let's write that journal entry together. We need to debit accounts payable Fox Pro for $5,000 to remove this liability from the books. We need to credit cash for $400 because we did pay them $400, and we need to credit a new liability account, notes payable Fox Pro, for $4,600. On July 15th, we borrowed $12,000 cash from Spring Bank. Let's write that one together as well. I think you remember from chapter 3, simply debit cash for the amount you receive from the bank as proceeds for the loan, and credit notes payable - Spring Bank. On July 22nd, we paid the balance due on the Fox Pro note. We owe them $4,600 principal, and in our last video, we calculated that we also will owe them at the maturity date $115 of interest. So let's record that payment. We need to debit the note payable, $4,600, to remove this liability from the books. We need to debit interest expense for $115 and credit cash for the total $4,715. On November 12th, we paid the amount due to Spring Bank at maturity. And in our last video, we calculated that at maturity, we would owe Spring Bank $400 worth of interest. I think you can write this journal entry on your own, so please pause your video, write the journal entry, then start the video again to check your work. In your journal entry, you should debit note payable Spring Bank $12,000, debit interest expense $400, credit cash $12,400. On December 6th, we borrowed $8,000 cash from Citibank. Go ahead and write the journal entry for this transaction, then start the video again and check your work. Debit cash $8,000, credit note payable Spring Bank $8,000. Now we're ready to accrue our interest at December 31st. In our previous video, we calculated the interest that needed to be accrued on the Citibank note of $50. That is a Chapter 3 journal entry. It's been a while since you've written an accrual journal entry, so let's write it together. And you probably remember from Chapter 3 that we need to debit interest expense and credit interest payable for the $50 of interest. And now we're ready to write our Year 2 journal entry. On January 20th, we paid the amount due to Citibank at maturity. Year 2, debit notes payable Citibank $8,000, which removes this liability from the books. Debit interest payable $50 to remove this liability from the books. Debit interest expense $40 for the 20 days we used the money in Year 2, and credit cash $8,090. Well, that's all for this series of video lectures on notes payable. When we come back, we'll start talking about other liabilities, including payroll liabilities. See you next time.